If you're watching silver at $74 right now, you're being shown the wrong price, because while New York is selling, Shanghai is paying a premium. And the reason isn't the market, it's the law. A single executive order most investors never read just rewired the silver supply chain. Take a second and really look at what's on your screen right now. It's not just red candles, it's fear moving in real time. Silver just took a hard hit. The spot price slid to $74.64, down more than 4% in a single session. Retail traders are rattled. Social feeds are filled with accusations of manipulation. Panic is spreading fast. But here's the problem. If you're panicking, you're focused on the wrong signal. Because while everyone is glued to the New York price, the real story is unfolding somewhere else entirely. Stop watching New York for a moment and shift your attention to Shanghai. At the exact same time, silver was changing hands in New York at $74. Buyers on the Shanghai Gold Exchange were paying $82.11 for the very same metal. Earlier in the day, that price briefly touched $86. That's an $8 gap. In normal markets, gaps close. In healthy markets, arbitrage erases them. But this isn't a normal gap. This is a signal flare. An $8 spread between East and West isn't just unusual. It suggests something inside the system is no longer functioning properly. It tells us the paper market in the West is under stress, while physical metal is being pulled eastward at a speed we haven't witnessed in decades, not since the structural dislocations of the 1970s. So why is this happening? Why is a global market designed to equalize prices suddenly ignoring the basic laws of arbitrage? The answer isn't on a price chart. It isn't in technical indicators. And it certainly isn't being discussed on financial television. The answer is buried in federal law, specifically inside a document almost no retail investor has ever read, a document quietly filed in the Federal Register. I'm talking about Executive Order 14346, and more importantly, a small but critical modification tucked inside Annex 2. While headlines have been fixated on tariffs targeting electric vehicles and semiconductors, the most consequential change slipped by almost unnoticed. A few lines of legal language, buried deep in the fine print, fundamentally altered the supply chain for silver. And that change is the reason you're seeing this chaos today. If you don't understand what Annex 2 actually does, you risk selling at the exact moment when the structural forces are shifting in the opposite direction. Over the course of this investigation, we're going to break down how this legal change set the stage for what could become the silver squeeze of 2026. We'll explain why the administration carved out a quiet exemption for bullion while aggressively taxing nearly everything else. We'll examine China's export controls that took effect on January 1st. And we'll answer the key question everyone is asking right now: is this drop to $74 a warning, or the final forced flush before the real shortage reveals itself? To answer that, we need to start with the law itself. When the Reciprocal Trade Act was signed and the International Emergency Economic Powers Act was invoked, sweeping tariffs were applied across the board: steel, aluminum, electronics, solar panels. If a product was manufactured in China, Mexico, or Europe, it was suddenly facing tariffs ranging from 10% to as high as 100%. The intent was straightforward: penalize foreign manufacturers and push production back into the United States. But there was a major flaw in that plan, a structural flaw that couldn't be ignored. The United States doesn't produce silver. We consume enormous quantities of it for missiles, solar panels, electronics, and medical technology. Yet domestic mining output is minimal. Had raw silver been subjected to those same tariffs, critical industries would have stalled almost immediately. So the policy architects made an exception. Annex 2 was created. The language is technical, but the impact is explosive. Goods listed under Annex 2 are exempt from reciprocal tariffs. Among those goods, bullion-related articles. Specifically, silver bullion, tariff-free. Think about what that means. If you import a finished solar panel from China, you face crushing tariffs. But if you import a raw silver bar and manufacture that same panel inside the United States, the tariff drops to zero. That isn't a coincidence. It's an incentive structure, a powerful one. The message to global manufacturers is unmistakable. Move your factories here, and your most critical input material comes in tax-free. Stay overseas, and your margins are destroyed. This is why factories are relocating, and it's why physical demand for silver inside North America is quietly accelerating. Now, layer in the timing. On January 1st, 2026, China implemented its own strategic export controls on key resources. They understand exactly what the U.S. is attempting to do. They know silver is essential to rebuilding industrial capacity, and they've responded by tightening supply. That premium in Shanghai? That's not speculation. That's policy in action. China is paying up to $86 to keep silver inside its borders. The U.S. paper market is pricing it at $74. Those numbers cannot coexist for long. When the math stops working, price discovery becomes violent. So why did silver fall today if the shortage is real? Because the pressure didn't come from physical demand, it came from paper. The CME Group raised margin requirements on silver futures, increasing the cost of holding leveraged positions. That forces weaker hands to liquidate. It's a classic liquidity flush. Stops get triggered. Price falls, not because demand vanished, but because leverage was squeezed out. And while that's happening, physical buyers aren't selling, they're buying. Vaults in Shanghai are absorbing metal. The flow continues east, and the discount created by panic selling is quietly being taken by those who understand the structure underneath the price. This is the setup. A tariff-free channel in the US pulling demand higher, an export wall in China constraining supply, and a paper price that no longer reflects the physical reality. That disconnect, that's the anomaly. And to understand where it leads next, we need to go deeper into how this legal loophole collides with industrial demand. Because once factories actually turn on, this imbalance stops being theoretical and becomes unavoidable. So here is the real question, and it is the one almost no one is asking yet. What happens when the US manufacturing engine actually turns on? What happens when brand new solar factories in Texas and Ohio go live and discover that the silver they need simply doesn't exist in sufficient quantity? This is where the story shifts from markets to machinery. Because in this next phase, we're not talking about speculation or sentiment. We and I are talking about industrial arbitrage, the kind that doesn't show up on charts until it's already too late. We're going to break down the solar panic and explain why this specific executive order didn't just shield silver from the trade war. It quietly positioned it as the primary beneficiary of the inflation the trade war creates. The flaw isn't in the market. The flaw is in the law. And when legal glitches collide with physical supply chains, the result isn't gradual. It's explosive. To understand why silver is coiling like a compressed spring, you have to stop thinking like a coin collector. You have to start thinking like a manufacturing CFO. So let's do that. Imagine you're the CEO of a major solar panel manufacturer. For the past 2 decades, your factories have been in Southeast Asia or China. Labor was cheap, logistics were predictable, margins were stable. Then the ground shifts under your feet. The timeline matters here because every piece of this stacks on top of the next. On April 2nd, 2025, the administration signed Executive Order 14257. At the time, it barely registered with the public, but it set the framework. Then, on September 5th, 2025, the hammer dropped. Executive Order 14346. These weren't cosmetic policy changes. They weaponized trade law. Using Section 201 protections and aggressive anti-dumping rules, the government imposed heavy tariffs on finished solar panels entering the United States, in some cases exceeding 50%. And on January 1st, those enforcement mechanisms fully activated. Overnight, your business model is broken. You can AT sell a product that's suddenly 50% more expensive than your competitors. You don't have room to absorb the cost. You don't have pricing power. You're boxed in. So you're left with 2 options. Option 1, shut down and bleed out. Option 2, move your factory to the United States. But here's the catch. And this is where the math turns hostile. Solar panels don't run on optimism. They run on silver paste, a lot of it. Today, the photovoltaic industry alone consumes nearly 20% of the entire global annual silver supply. And if you relocate production to Texas or Ohio to avoid tariffs on the finished product, you now need to source that silver domestically. That's where the numbers collapse. Because the United States is, quite literally, a geological ghost town for silver. We consume massive quantities across electronics, solar, medical devices, and defense, but domestic mining output barely registers. According to the latest data from the U.S. Geological Survey, the U.S. produces less than 1,000 metric tons of silver per year. Meanwhile, American industry consumes close to 8,000 metric tons annually. Do the math. We produce 1, we consume 8. That's a structural deficit of roughly 7,000 tons every single year. Historically, this imbalance wasn't fatal. We simply imported the difference. The system worked because global supply was open and frictionless. But now, remember the anomaly from part 1. The executive orders built a tariff wall around finished goods, while leaving a narrow, deliberate exemption lane open for raw bullion. This was Washington's attempt to plug that 7,000-ton hole, a signal to the world, send us silver and we'll take it tariff-free. The problem is, the world isn't cooperating. While policymakers were signing executive orders in late 2025, the rest of the world was doing something very different. They were hoarding. This is resource nationalism, and it's accelerating. Mexico, Peru, China. These are the countries that actually control silver supply, and they're starting to restrict exports, not out of spite, but strategy. They want to build their own solar panels, their own weapon systems, their own industrial bases. They don't want to ship raw materials to the United States, just so America can re-industrialize at their expense. So now we're trapped in a collision. U.S. demand is going vertical because factories are being forced to reshore. Global supply is contracting because exporting nations are closing ranks. That combination creates something most investors aren't prepared for: biflation. This is a term you need to understand. It means deflation in the margins of importers and inflation in the raw materials required for domestic production. Finished goods get squeezed, input costs explode, solar panels become more expensive, electric vehicles see rising costs of goods sold. This is classic cost push inflation. And historically, what protects against inflation? Silver. But now silver has a dual engine. On one side, investors are buying it to protect purchasing power from tariff-driven inflation. On the other, industrial giants, companies like Tesla, Samsung, and First Solar, are buying it because if they don't secure physical supply, their assembly lines don't run. That's why today's price action is so misleading. The paper market is reacting to interest rates, margin requirements, and Federal Reserve expectations. The physical market is reacting to inventory, and the inventories are disappearing. COMEX registered supply, the silver actually available for delivery, has dropped to historic lows. We're not operating with a cushion anymore. We're operating on fumes. And in the next part, we need to examine what happens when that fuel gauge finally hits zero, because that S where price stops being theoretical and starts being forced. Now we need to address the pressure point everyone underestimated: the solar panic. For years, there was a comforting assumption baked into the market. Analysts believed solar manufacturers would simply learn to use less silver over time. They called it thrifting. Engineers experimented with copper substitutions. They tried printing thinner conductive lines. They optimized every gram. And for a while, that strategy worked. But in 2025, the industry hit a wall. With the large-scale adoption of TOPCon and HJT solar cell technologies, efficiency demands crossed a physical threshold. These next-generation panels are not optional upgrades. They are required to remain competitive, and you cannot remove silver from them without destroying performance. There is no substitute at this level. So, at the exact moment EO 14346 forces manufacturing back onto U.S. soil, the technology itself demands more silver than ever before. That's the squeeze. And this isn't speculation. It isn't sentiment. It's not a theory. It's an industrial accounting failure playing out at a national scale. The government assumed that by exempting bullion from tariffs, supply would naturally flow where it was needed. But that assumption breaks down at current prices. At $74 an ounce, miners cannot scale production fast enough to meet this surge in demand, especially when buyers in China are willing to pay $86 to keep metal inside their borders. Something has to give, and it won't be marginal. We are not talking about a move to 80 or 100. We're talking about a repricing of silver based on its industrial utility, not its paper valuation. The price has to rise to a level that breaks export barriers and pulls physical metal back into circulation. But there's another layer to this trap, and it affects everyone watching, whether you own silver or not: the currency itself. Because when you start a trade war, you don't just create economic friction. You trigger a currency war. Tariffs are sold as a way to protect the dollar. In reality, they do the opposite. They erode purchasing power by making everything more expensive. And this is where the next phase of the crisis begins. In the next part of this investigation, we'll walk through the currency contagion. I'll explain why the Federal Reserve is trapped, unable to raise rates without collapsing the manufacturing revival it's trying to support. And we'll examine the wealth transfer now underway, as institutional money uses this temporary dip near 74 to exchange weakening dollars for the only asset legally shielded from the trade war. The trap is already built. Factories are under construction. Vaults are being drained, and the price is tightening like a loaded spring. We've already covered the supply shock. We've broken down the industrial vacuum. But there's a third pillar to this crisis, one that may prove more dangerous than the other two combined: your money. Because Executive Order 14346 didn't just fracture the silver market. It quietly destabilized the bond market, and in doing so, it put the purchasing power of the US dollar at risk. Here's the reality. Washington avoids saying out loud, tariffs are taxes. When the Reciprocal Trade Act was fully enforced in late 2025, it effectively imposed a sales tax across the global supply chain. When a US company imports electronics from Asia and pays a 50% tariff, that cost doesn't disappear. It gets passed directly to the consumer. That's called cost push inflation. And here in January 2026, we're watching it take hold. Prices for vehicles, appliances, and building materials are rising week after week. Under normal conditions, the Federal Reserve has a clear response. Inflation goes up, rates go up, liquidity tightens, demand cools. But this time, that playbook doesn't work. This is the Fed trap. The entire objective of the new trade regime is to bring manufacturing back to the United States. But manufacturing requires debt. It requires cheap capital. If the Fed raises rates aggressively to fight tariff-driven inflation, It kills the very factories the policy is trying to create. Raise rates to 10%, and solar plants in Texas go bankrupt before concrete is poured. So the Fed is boxed in. They have to keep rates artificially low to sustain re-industrialization. While inflation runs hot due to tariffs, this is financial repression. It means your savings lose value quietly, month after month. Your purchasing power is being sacrificed to fund the trade war. And that brings us back to the silver exemption. Why did the administration deliberately carve bullion out of the tariff system? Why create a single lifeboat while everything else sinks? Because the architects of this policy understood the consequence. They knew tariffs would debase the currency. They knew restricting cheap imports guaranteed domestic inflation. So they left the door open for real money to enter the system. The silver exemption isn't just an industrial subsidy. It's an unspoken acknowledgement that the dollar is going to lose ground against hard assets. What emerges is a two-tier system. Tier 1, consumers. You pay more for everything, while your dollars buy less each month. Tier 2, asset holders. You own the exempted commodities, gold and silver, that reprice higher as the currency weakens. This is one of the largest wealth transfers of our lifetime, and most people are positioned on the wrong side of it. They're arguing about grocery prices, while institutional capital is quietly draining the COMEX. Look at the chart we referenced earlier. Gold is trading around 4,235, and that number matters because it tells us exactly where this imbalance is heading next. Gold is doing exactly what it's designed to do. It's already responding to inflation. It's already moving ahead of the curve. But silver, sitting near $74, is clearly lagging. Right now, the gold to silver ratio is hovering around 60 to 1. Historically, that's an extreme. In periods of sustained inflation and industrial stress, that ratio doesn't stay elevated. It compresses, often violently, toward 40 to 1, sometimes even 30 to 1, and that math matters. Because at current gold prices, silver would need to nearly double just to catch up, and that assumes gold goes nowhere from here. That assumption is unrealistic. What we were facing is a rare alignment, an asset that functions as both a safe haven and a critical industrial input. Silver doesn't just protect purchasing power. It directly benefits from the manufacturing demand that inflation creates. More importantly, it's the only major asset that is legally exempt from the very trade war fueling that inflation. This is the feedback loop. Tariffs push prices higher. Higher prices drive investors toward hard assets. Investor demand tightens supply. Tighter supply pushes prices higher, precisely when industry needs the metal most. That's how systems break. So where does this end? If factories are desperate, the Federal Reserve is boxed in, and vault inventories are thinning out, what is the real price of silver in 2026? It's not $74. That number is a paper reference, a futures contract price quoted on the New York Exchange. It represents a promise to deliver metal that may not actually be available when demanded. For decades, bullion banks managed this system by selling paper supply, confident most buyers would never ask for physical delivery. Positions were settled in cash. The illusion held. But Executive Order 14346 changed the nature of the buyer. Today's buyers aren't hedge funds chasing short-term returns. They're manufacturers, defense contractors, industrial giants, companies like Tesla, First Solar, Samsung, firms that cannot operate without physical metal. You can't build a solar panel with cash. You can't build a missile with a wire transfer. At some point, delivery matters. And when delivery is requested and the vaults are empty, the system hits its breaking point. That's when markets disconnect. We're already seeing the first cracks. That persistent premium in Shanghai isn't noise, it's price discovery. It's the physical market clearing at a higher level, while New York remains artificially restrained as paper positions scramble for cover. But that disconnect cannot last. Arbitrage isn't optional, it's mechanical. If silver is materially cheaper in New York than in Shanghai, metal flows east. Every ounce that leaves drains Western inventories further. To stop that drain, the U.S. price has to rise, not because anyone wants it to, but because the math demands it. So let's talk targets. Gold is trading near $4,135. At a 60 to 1 ratio, silver is historically undervalued. If the ratio compresses back to 40 to 1, silver prices imply roughly $110 per ounce. That's the conservative scenario. But this isn't a normal market cycle. This is a manufacturing supercycle layered on top of tariff-exempt bullion. If the ratio compresses to 30 to 1, a level seen in prior bull markets, silver moves toward $147. And if a genuine delivery squeeze forces short sellers to buy at any available price, the chart stops mattering altogether. Price discovery becomes vertical, which brings us to the final verdict. The silver exemption wasn't an oversight. It was a structural decision. By exempting bullion from tariffs, policymakers funneled demand into a market with limited supply. And in doing so, they destabilized the paper pricing mechanism. This wasn't just a loophole, it was a trigger. And for a brief window, that trigger creates an opportunity. Right now, physical silver can still be acquired near the paper price. That gap won't exist forever. Once New York is forced to reconcile with Shanghai, the repricing happens fast. The volatility you saw today, that sharp 4% drop, isn't a warning, it's a shakeout. It's designed to force weak holders out before the adjustment. The executive order is already signed. Factories are already retooling. Inflation is already embedded in the system. The only thing left unresolved is the price. And that leaves you with one final question. The only question that actually matters: when the paper price finally gives way to physical reality, will you be holding the contract or the metal?